Good, very good. So, good evening, everyone. I'm happy to be back. I'm glad to see that you're back as well. So, we're going to resume our class on money creation and monetary policy. And today, we're going to spend quite a bit of time talking about monetary policy, right? Because we've worked already on money creation. We are not done yet with money creation, but we've done probably the most important items. So now that it's clear for you, we need to move forward with monetary policy, which is the process through which the central bank controls the creation of money supply. So I suggest, so I've shifted to, let me shift that back to English because it's currently French. Right there, okay. I suggest I like to do that, and I think it's useful for you that I make a quick summary of the last class. So I've shifted to share notes. So in particular, summary on money creation to make sure that it's clear for everyone. Okay. Um, so what we've seen is the following: in the commodity money system, is money made of gold and silver coins. Some let's say banks, realized they could print or issue more bills, which we also call certificates of deposit, than they had gold coins in their vault, right? And that was a key step. I emphasize that, right? It was really, really important because there was this suddenly this possibility to disconnect the amount of money in circulation in the form of bills from uh, the amount of gold available in the economy as a whole, right? So there was disconnection between the money supply in the form of bills and the amount of gold and silver in the economy. For the commodities money system. How about today's monetary system? Well, it's the same in the following sense. Banks, commercial banks, can issue more deposits than they have base money as reserves. Okay? They do that through loan. Every time they lend money, they create new money. So every time the bank lends money, it creates new money. Therefore, the amount of deposit is soon greater than the amount of base money. Right? So that's very important, right? And every time the loan is paid back, some of that newly created money is destroyed. Right? So the important thing to realize that in the economy there are always new loans being granted and there's always old loans being paid back. The net difference between new loans and old loans being paid back is usually positive, especially when the economy is growing. So that this explains why the money supply keeps increasing over time, right? And I'm going to show you some statistics about that, but it's typically increasing roughly at the same speed as the GDP. It has to, right? Um, Unless there's some big technological change that would reduce the velocity of money or this sort of things. But typically, you tend to see GDP and the money supply moving together, right? When the economy is growing fast, there's a lot of credit going on, and therefore a lot of money being created. So more loans are being granted than loans are being paid back, and therefore the money supply increases. And when there's a recession, when the economy shrinks, then that means not much credit is being created, therefore not much money is being created, perhaps less than the former loans that are being paid back, and therefore the money supply will shrink as well. So you do see this sort of correlation between GDP growth and the money supply growth. It's not perfect. It's not one-to-one correlation, and it depends on the country. And also the technology used for money can play a role, but typically you tend to see this sort of correlation, right? So this is really important. Um, the other thing that I would like to remind you is about the reasons why commercial banks are holding base money in reserve. So here I'm asking you, actually, I'm asking a question, if you don't mind. So I'm going to shift back to the public chat. Why do you think, without looking at your lecture notes, why is it you think commercial bank they're holding base money as reserve? We've discussed that yesterday. There are a few reasons I would like them. Yes, interbank payment, very good. What else? I'm going to explain them again, but so we do have interbank payment. You're right. What else do we have? Regulation requirement, exactly. That's in cash withdrawal. So the three of them. Thank you very much. So very good. You're a very good student, but I knew that. You're right. You're right. There are three reasons actually. Three reasons. We're gonna do the first one. It's very easy. It's cash withdrawal. When you go to the bank, to the ATM machine, you want cash for whatever reason. The bank has to provide this cash, right? And we know that cash is base money, right? Oh, uh, so I'm shifting back to the public chat and I'm asking you, what is the other part of M0? So the base money, one part of base money, one part of the M0 aggregate is cash. What is the other part of M0? What's the second component of M0 of the base money? Remember what we said yesterday? M0 equal bills plus I'm talking about base money here, this aggregate. M0 equal bills plus exactly deposit by commercial banks at the central bank. You're exactly right. That's, those are the two types of base money, right? So answering it's here and moving back to share notes. And right. So the second reason is interbank payment, as you said. We made an exercise yesterday about that. Perhaps exercise one or two, I don't remember. And every time a bank is in debt towards another bank, it has to settle that debt with base money. At least that's the rules in the West. When you're not supposed to use the Vostro and Nostro account. I know that you do that in Vietnam. That's fine. We're going to talk about it, but forget about the Vostro Nostro for now. Just think that Vietin Bank owes money to Vietcom Bank. It has to pay with base money. End of story. Third reason is the reserve ratio requirement. For that, and what's the reserve ratio requirement? You know that. It's 3%. In Vietnam, it's 3%. So those are the three reasons why commercial bank will hold base money. And you see, and I'm going to put that in bold. The big, the larger the amount of deposits, the greater the need for base money. Because for three reasons: one, two, and three are proportional to the amount of deposits, right? So it's important to realize this, right? So bigger banks, by that I mean banks with a large balance sheet, have greater needs for base money, right? Finally, as a summary, I want to talk about incentives for banks to create money. That is to make loans. So I said I would put that in bold, so I'm going to do that bold, and I'm going to emphasize it this way. Okay. And now I want to talk about the incentive for banks to create money, that is to make loans. Well, this is their main source of income. That's as simple as this. Banks are not earning much money by charging banking fees. The lion's share of their income comes from interest revenues, right? The interest rate they charge on loans. Okay. So it looks like they have an incentive to create as much money as possible. Well, not exactly. Okay, banks need to be careful in their lending operations, right? They must select customers that are able to pay back. Otherwise, it's a loss for the bank, right? Okay. So, but still, banks can be tempted to lend too much money, especially when interest rate, when the policy rate, I'm going to talk about that, is high, is low, right? Why? Because the policy rate is the cost for commercial banks of accessing base money, right? By the way, so I'm going to move back to the public chat because I want to ask you a question. There are two ways banks can have access to base money. What are those two channels? Exactly. They can come to exactly. Thank you very much. We have both of them. Either they knock on the central bank's door, and they borrow from the central bank directly. In the US, this is called the discount window, right? And or they can go on the interbank market. So I'm moving back to share notes. And the two channels, there are two channels for. Oh, by the way, haha, I'm going to save me some time. When I say CB, small cap, it means commercial banks. Okay. When I say CB, it means central banks. Okay. That save me some time. So there are two ways for commercial banks to access base money. One, borrow from the central bank directly. Second, borrow on the interbank market. So you wrote internal market. No, it's interbank market. Right? Perhaps that's what you wanted to say. Interbank market from other banks. Right? Sometimes the central bank will be there as well. Okay. So there are two channels, right? All right, and the cost of base money is the famous rate, and usually called the policy rate, right? It has different name, depends on the country. What would be the name in Vietnam of the interest rate set by the central bank on the interbank market or on the discount rate? Does it have a particular name? That's a question I'm asking you. I usually go by policy rate because everybody understands what that means, but in some countries it has a particular name, so that's why I'm asking. Well, if nobody knows, I'm gonna find out for tomorrow. Otherwise, I'm gonna keep using that policy rate terminology. I can see someone is working, and it is a lady. I can tell that. For repo, it should be discount rate. Yeah, we can say that. We can say that. It's a slightly more involved operational repo, so I'd rather not mention that. Now we're gonna talk about it later. Okay. But thank you. Okay, I guess that's it for the summary on money creation by banks. I hope you guys. I can export that file, but perhaps you wrote that down. Export to different. Well, I'm gonna try to do that at the end. But maybe you've copied it already. I'm not sure. But I'm gonna try to put it as a file. Okay, so now that we've done that, I think we are equipped to start section two, right? Unless, do you have any question? Do you have any question at this stage? Before we start section two. Someone is typing, so I'm waiting for the question to show up. I'm not sure if you can see that as well, but I can see when someone is typing. Multiple users are typing, so there's going to be multiple questions. May I know why the interest rates of the loan will credit to the loan, not credit to base money? I'm not sure I understand your question. Perhaps you're saying Yesterday, in the example that I draw, I increased the loan amount by the interest amount, right? Is that what you are referring to? Yes. Well, because the debt, it's a debt, right? But assume you borrow 10 grand, you borrow 10,000 US dollar to your bank, and you commit, you sign a contract saying, I'm going to pay back 10 grand plus the 10% interest rate, right? So at the end of the year, you're going to have to pay 10 grand plus 10% of 10 grand. That's 1 grand. So that's 11 grand. So you owe that money to the bank, right? So you're going to have to pay back so what I'm saying is that the loan amount, your debt has increased by 1,000. Um, so that's why the loan increases from 10,000 to 11,000. So I see no reason why the base money will increase. For the base money on the asset side of a bank to increase, there's only one way. It means the bank receives cash or receives base money, either in the form of a cash deposit by one of its customer or through bank transfer at the central bank from another commercial bank. Okay, so that's why. I hope I answer your question. I'm gonna take 10 seconds to open the door because my cat wants to come in. I'm sorry. All right, the cat is in, so he's very quiet. He's not going to disturb me. All right, there you go. Please move that. Oh, hello. Okay. So second question for I thought that is the bank's income and will be credited to base money. However, I can understand now. Um, no, but on the asset side, the amount of the debt increases. So it yeah, it has to increase the loan amount. I see no other way, right? Um, okay, so other question. For the borrowing options, if a bank choose to borrow from other bank in the interbank market, how that process will work? Well, we're going to talk about that today, right? It's called open market operations. Open. No, it's not called open market operations. Sorry, that's something different. But it's just it's just a market for base money, right? So we're going to talk about that. So I save my answer for later. Other command. Every time a bank lends money, it creates new money. Yes, therefore, the amount of deposit is soon greater than the amount of base money. So, to to what ratio loans reserves the commercial bank should stop increasing loans? Well, first of all, it is constrained by the reserve ratio requirement, right? So if it has $3 as base money on the asset side, it cannot have deposits larger than 100, right? So that's pretty much the only constraint a commercial bank is facing. It's the reserve ratio requirement, but it can always. I mean, it's a dynamic. You should see it as a dynamic picture, right? It's not like the commercial bank has $3 and it's going to stuck and stick to its $3. If the commercial bank wants to expand its portfolio and therefore its deposits, the all it has to do is to borrow more base money to have more base money on its asset side. Therefore, it can expand its deposit, right? So let me read again your comment to make sure that I understand it. Every time a bank lends money, it creates new money. Therefore, the amount of deposit is soon greater than the amount of base money. Yes, definitely. And the difference being the loans, right? So, to what ratio loans divided by reserve the central bank should stop increasing? As I said, it depends on the reserve ratio requirement. But because the commercial bank can always increase its amount of reserve, then it can do whatever it wants, right? So the limit is the sky, in one sense, right? It really depends of the solvability and the profit expectation with the people that are asking for a loan, right? Banks will not lend money to people that are not able to pay back, right? Um, Otherwise, they're going to be losing money, right? Um, I think we talked about that yesterday. In the EU and the US particular, it's general. It applies to anyone. So the reserve ratio requirement is important, but because you can expand the amount of base money that you hold, you can expand your loan portfolio. It's important to understand. We're going to talk about that as well when we're going to talk about endogenous limits to money creation, right? In boom times, all banks are lending a lot of money. So it's difficult for a bank not to do as other banks are doing, and that's one issue. I thought that the bank's income and will be credited to base money. It would be no. I mean, it depends. The only, however, I can understand. Okay, so we talk about it. Okay, so I guess if there's no more question, we can start. It's gonna clarify, I'm sure, when you understand a bit more about the role that the central bank is playing. Okay, so let's start. Okay, so money, inflation, and monetary policy, section 2. So we're going to talk about monetary policy. And let us start with the goal of monetary policy. So we're going to step back a little and try to figure out why is that there is monetary policy. By the way, why do we need monetary policy? You should always ask yourself this sort of question and don't take anything for granted. Why is that there is monetary policy? Why is that do we need a central bank? I'm going to tell you later on this week or perhaps early next week that we don't really need a central bank. That's my point of view. A lot of people are sharing it as well. Sometimes central banks do more harm than they do benefits. This is very obvious for the last financial crisis. But still, people consider that it's a good idea to have a central bank in order to conduct monetary policy. So let's have a look at the rationale and the reasons and the motivation behind such monetary policy. All right, so let us slide 3. So monetary policy aims at influencing the amount of private money available to agents in the economy, that is keeping an indirect control over the money supply. Okay, and by private money, I pretty much mean deposits, right? It's right? That's what private money is. It's important to understand that so this account that you have at your bank, it's private money. It's been issued by a private commercial enterprise, and indeed it's a commercial bank, right? So it is private money. So it's different from base money. So monetary policy aims at influencing the amount of private money available to agents in the economy. That is keeping an indirect, I'm going to see that this word is important, indirect control over the money supply. It's definitely not direct, right? Um, because banks are free, right? The banks are free to give whatever amount of loans they want. The only thing the central bank can do is try to influence that amount by making the cost of base money more or less expensive. That's the only thing it can do. But it is not up to the central bank to decide about the amount of credit in the economy. Right? It's just indirect. So keep that in mind. And why does the central bank wants to do this sort of indirect control? It's because its mission, right? Its mandate. Yes, let's use the right word. Its mandate is to keep inflation under control. And by under control, it's usually between 0 and 3%, right? Depending on the country. Because why is that? Because too much money creation creates too much inflation, and inflation is bad for the economy. We're going to see that in a moment. Okay, So to summarize, monetary policy is about controlling the amount of deposits being created by commercial banks. This control is only indirect. And why does the central bank want to do that? It's because too much money creates inflation. Inflation is bad. Okay? And we're going to see why inflation is bad. There are pretty much two reasons why. The first one is that inflation is not positively correlated with economic growth. Second, there are a whole bunch of costs associated with inflation that we're going to look at in details. Final bullet point here, this goal is tasked to the Reserve Bank, and in Vietnam the Reserve Bank is called the State Bank of Vietnam. By the way, I visited two very nice museums in one in Ho Chi Minh City and one in Hanoi. And both had a very nice exhibit on the monetary history of Vietnam. So I strongly recommend that you do that. It's very interesting, right? And you have one in Ho Chi Minh and one in Hanoi. So nobody will be jealous. You can all visit your own museum. Very interesting. Let's move on. So why is it important to keep control of the money supply? Yes, by the way, that was my introductory question. Why do we need control? Why do we need monetary policy? The first reason is actually perhaps the most important one, because too much money generates inflation without improving productivity. Right? But I'm going to make a quick reminder on economic growth here. Quick reminder on economic growth. The reason why some countries are richer than others is because labor is more labor is more productive in poorer, rich countries, right? And why is it more productive? Because we have good workers on average have more physical capital, machines, infrastructure, etc. More human capital, that's education, experience, know-how, and technological knowledge. Because workers on average have more physical capital and human capital, and the level of technological knowledge is greater. This is economics 101. Economic growth theory. So a country is rich for just one reason, because its labor is productive. And why is labor productive? There are three main inputs to labor productivity: the amount of physical capital with which workers are working, the amount of human capital, that is the level of education, and also the level of technological advancements, right? So now I'm going to start a poll. In my very, very quick reminder on economic growth, did I mention the word inflation or money? Please answer my poll. I'm talking about this very quick reminder on economic growth. Did I mention once the word money or inflation, except outside of my question? So the question is, because someone asks me to repeat the question, I've done a very quick reminder on economic growth, as you can see, right? Trying to explain why some countries are rich, some countries are poor. And my question is, did during this very brief explanation and reminder, did I use the word inflation or money? Yes, I did not. Very good. I did not use the word money. Okay. Why? So I'm half joking here. The thing I'm trying to say is that in the long run, if you want to explain living standard differences across countries, it has nothing to do with inflation or nothing to do with money. It's all about labor productivity. I'm not saying money doesn't have an impact in the short run, right? Uh, it definitely can, but over the long run, it's not related to money and inflation. And in particular, it's not because you have higher inflation that you're going to be growing faster in real terms, right? So, and that's going to become clear when we move to the next step. So, I'm going to move back to the chat. Thank you for answering my tricky questions, which was a trap question. Most of you answered correctly. So good. So look at this graph, for instance. Very interesting graph. So let's go through this graph together. So why is it that we have on the horizontal axis, we have the money growth rate, right? And we're talking about M2 here, okay? You remember what M2 is? M2 is M1 plus savings accounts. So it's kind of a bigger measure of the money supply. M1 is bills and coins plus demand deposit, what you call CASA. And M2 is M1 plus the savings deposit, right? Now let's have a look at what you have on the vertical axis. On the vertical axis, you have inflation. That is the growth rate of prices, right? By how much prices increase on average. And what are all those little dots here? And they represent one country. For instance, here you have one country, here you have one another. And how do we plot them? Well, for instance, for this country, let's call it country number one, you would take the average growth rate of M2 over the 1960-1990 period, right? You see that here? So we take the average growth rate of M2 over the 30-year period, and we have a number. And that's, in case of country one, that would be a little bit above 40%. Then we do the same for inflation, right? That is, we take the average inflation rate for that same country here over a 30-year period between 1960 and 1990. And we get something around here, right? So this dot is a coordinate actually for one particular country. And we do that for 110 countries. Can you see that? 110 countries here. So you have actually 110 dots on this graph, right? And then we try to see whether there's some sort of relationship between money growth and inflation. You see? And what do we see? We see that there tends to be actually a relationship in the sense that if we remove this country, which might be an outlier, there is a positive relationship, which means the higher the money growth, the higher the inflation rate, right? Higher money growth, higher inflation rate. Higher money growth, higher inflation rate, right? So there is a positive relationship between the growth rate of the money supply measured by M2. Remember, we're talking about M2 here. And inflation. It's not really surprising, right? The more money in the economy, the greater the inflation rate. Well, people expect that. The next graph is more important for our purpose. Remember, we're trying to understand why we need monetary policy. Well, this slide provides an answer because if you look at the x-axis, again we have money growth rate, again we have M2, again we have those 110 countries, again we're looking at between 1960 and 1990. However, now if you look at the vertical axis, we don't have inflation rate anymore. We have the average real, important real in the sense that we've removed the impact of inflation. We have the average real output growth. And we're trying again to find whether there's some sort of relationship between the growth rate of the money supply and the real output growth. That is real growth in the economy. And what do we see? Well, it looks like this time there is no relationship, right? It's flat. It's flat, just like a straight line, right? So it means that, well, regardless of, I'm going to pick orange, regardless of the growth rate of the money supply, slow rate, small growth rate of the money supply, or bigger one, not much of an impact on the real growth rate of GDP. So the bottom line is the following. I want to write in pink in that color. Bottom line, there is no long run positive relationship between the growth rate of the money supply. Here we're talking M2, but it could be M1, M3, would not be very different. There is no long run positive relationship between the growth rate of the money supply and the real GDP growth and real GDP growth. I couldn't write my H. There's an H missing. Growth. Okay. There is no long run positive relationship between the growth rate of the money supply and real GDP growth, right? Another way of saying it is to say that having higher inflation by creating too much money, for instance, is not going to make you a rich country. You see, this is what the data are saying. We're going to write that here. The data have spoken. Okay. Hope you understand my point, right? Those economists, McCandless and Weber, they've done this study, but you have a lot of very similar studies done by other people. They're trying to see whether over the long run, countries that have higher inflation grow faster in real terms. No, the answer is no. So that's the first reason why we should not we should be careful with high inflation, because high inflation doesn't make you richer than low inflation, right? At least there's no relationship. What we know is that there is a positive relationship between the growth rate of the money supply and the growth rate of prices, but there is no positive relationship between the growth rate of the money supply and the growth rate of real GDP. Okay, so I think I made my point here. But that's the first rationale to explain why we need to keep some sort of control over the money supply. Okay. Some vocabulary now before we move to the other reason why inflation is bad. Hyperinflation, you may have heard about that word. So hyperinflation means inflation that exceeds 50% per month. So it's very high level of inflation, right? We have a few examples in history. For instance, Germany in the 1920s. The cost of a newspaper in January 1921 was zero point 0.3 Deutschmark. So DM means Deutschmark. That's before the euro, right? Was the name of the German currency, the Deutschmark. But if you look at the same newspaper 2 years later, that same newspaper was costing 70 million Deutschmark. So we moved from point 0.3, hmm, we moved from point 0.3 Deutschmark to 70 million Deutschmark in 2 years. It's insane, right? This is hyperinflation, right? This is very bad for the economy. Typically, the economy totally collapses when you have this sort of thing. So that's an old example, but we today we have a more recent one coming from Venezuela. So let's have a look at some statistics for Venezuela. So this is Venezuela's annual inflation rate, starting from June June 2014 up to August 2017. We're talking about an 1800% inflation rate. So that's a lot of inflation. Okay. Um, and as you can see, the GDP was falling. That's a 2015 GDP, 2016 GDP, 2017 GDP. So by the way, I said there's no positive relationship or negative relationship between inflation and GDP growth. I want to add a comment here. So no relationship between inflation and real GDP growth. However, there is a strongly negative relationship between hyperinflation and real GDP growth. As you can see here in the case of Venezuela, right? So hyperinflation is very bad. Look at those figures for Venezuela. I mean, it's the GDP has fallen by 1/3. That's massive. Okay. Right. Sometimes prices fall as well. I'm taking this opportunity to introduce some more vocabulary, right? And I'm briefly going to cover the second reason why we need monetary policy, but introducing some vocabulary. So deflation, what is deflation? Deflation is when prices fall. Okay? One example that is famous in economist history is the second half of the 19th century in the US, where prices fell by 23% between 1880 and 1896. But more recently, Japan has been known for um, uh, being going through various phases of deflation since the 1990s. Why? You may know that, but there was a big housing stock market crash in 1989, 1990, right? Japan. So this triggered some sort of deflationary spiral. We're going to come back on this, I think. This is the price growth in Japan, right? As you can see, so this is the inflation rate right there, annual inflation rate. And here you have time. the years. As you can see, um, so that's the stock market crash, right? As you can see, prices went down. They rebounded somehow, and then very long period of deflation, right? Throughout the late 90s, early 2000, and then another bout of deflation here, right after the 2008 financial crisis, which was right there. Right? So, but it's pretty rare, right? Deflation tends to, outside of Japan, deflation tends to be rare. Right? There's not much deflation going on usually. All right, so another way of looking at it is to say that when you have inflation, actually it's the value of money that decreases. If prices go up, that means the value of money decreases. By contrast, when you have deflation, that means prices are going down. So one unit of money buys more, so that means that the value of money increases. Okay. It's important to not to confuse deflation with disinflation. Deflation means the prices are falling, whereas disinflation means the rate of inflation is falling. So that means prices are still increasing, but not as fast as not as fast as they were. Okay, it's the rate of inflation that's falling. So you need to be careful here when you're using this vocabulary, not to um, confuse the two. Right, some more data here. I think it's important to have some data. So we're looking at the inflation rate in Japan and the UK starting in the late 70s, no, starting in the mid 50s. So you can see there was quite a bit of acceleration in inflation, and throughout the 90s, um, inflation was pretty high in Europe, and then it started falling down. Okay, and it's under control since roughly the early 90s, right? Okay. More data. This is in Australia, New Zealand. Again, same sort of pattern, rising inflation, 60s, 70s, then quite a bit in inflation during the 70s, and then inflation going down. Okay. This is for India and Indonesia. Um, Not much to say. Perhaps something that is important to realize that typically in developing countries, the average level of inflation is higher. As you can see how it's not too far from 10. So this is the Asian crisis, right? The 1997, 98 Asian crisis. About that. Vietnam was not that much impacted. The worst hit country as well was Indonesia. Um, but the point here is developing countries tend to have higher inflation rates because they are growing faster, creating a stronger demand for production factors. And anyway, typically that's what you observe, right? Higher, but even in Vietnam, you tend to have a bit more inflation that we have in Europe. Bottom line, no more money, sorry, more money does not mean higher long-term growth. If GDP does not increase in parallel, then more money does just means higher inflation. Okay? The role of the central bank is then to keep inflation under control. And so typically, there would be a mandate given to the central bank that would say, well, we want you as a central bank, as a public institution, to keep inflation with some sort of acceptable range. And depending on the country you're looking at, but typically that would be between 0 and 3%. Okay, that's the target. Okay, and sometimes we call that inflation targeting. Okay, the idea being that the central bank must make sure inflation stays within that range. Okay, that means um, um, playing with the policy rate to boost or slow down the creation of credit. Okay, we'll come back on that. All right. Okay, so let me summarize what we've just done. So, for countries with higher inflation rates do not have higher standards of living. That's pretty much what it says, right? Um, but now we are going to see that inflation is actually costly. Therefore, we should minimize minimize it, or at least keep it under control. That is within that 0 3% range. Maybe I want to ask a question now. Um, why not target deflation? I'm going to put that in the chat, right? Why not target deflation? Why? Let me put it this way. Why is the central bank um, should the central bank target some deflation other than low inflation? By that I mean 0 to 3%. That's the question I'm asking you. Should the central bank target some deflation rather than low inflation? Yes, no, why, please? Not an easy question, but you may have an idea. Mhm. No idea. Should the central bank target some deflation rather than inflation? Let me phrase it differently. Is deflation good or bad? Bad. Yeah, I would tend to say yes. It is bad, but yeah, I agree. Deflation is not that good. But why? You have some idea why deflation is not great? It's good and bad. I like that. It's good and bad. That's some good. but depend on this country because people will keep money in saving. Yes, I like this answer. Thank you, young lady. Um, in case inflation is too high, central bank should target deflation. Not sure about that. I'm going to come back on that first comment here because people will keep money in saving. Yes, that's right. I think deflation is a dangerous path. Deflation is a dangerous path. Why? Because agents postpone their purchases, purchases, waiting for prices to fall. Exactly. Deflation means lower prices, means low total spending, means lower economic growth. A lot of interesting comments. Thank you. Let me finish this reasoning. Deflation is dangerous path. Why? Because agents postpone their purchase waiting for prices to fall. So they wait 1 month, prices fall, and they were right. But why not wait another month then? Because prices will fall even further. So let's wait. But then maybe if you wait even more, prices will fall even more. You see, everybody thinks this way. Very soon, the economy goes to standstill. That is, the economy stops. But there's always going to be some buying for the what we call non-durable goods. There is always non-durable goods. Agents will still buy non-durable goods, but will postpone durable goods. Durable goods, I mean cars, apartments, fridge, and so on. You see? So yeah, typically you don't want to have too much deflation, right? Because there's always a temptation to postpone your purchases to wait, right? But there's one interesting comment from one lady who said they can buy more good with the same amount. Yes, you're right. You're right. But you see, if everybody does that, that becomes a very slippery slope, right? Everybody's postponing their purchase, and then that's dangerous. Someone else said, in case inflation is too high, central bank should target deflation. Well, that's a big step. If inflation is too high, it means that people have high inflation expectations. So they expect inflation to be high. So typically, business is gonna set higher prices in accordance to the high level of inflation. Employees will ask for pay rises in order to match the inflation rate. So it's very high to decrease high levels of inflation. So it's even higher, if not impossible, to jump from high inflation to deflation, right? You will have to not only stop any new money creation, but withdraw money from the economy. And that, I don't think no country has ever tried to do this. Okay, when you have high level of inflation, you should first try to decrease inflation and then maybe later move into deflation. But typically, and I'm going to write that in the chat. I'm going to write that here. Um, no country is targeting deflation. Um, where is targeting deflation? It's just too dangerous. I know you say that's why they keep falling. That's why they keep waiting. But still, if they wait, the whole economy is gonna slow down. So typically, most countries, most policymakers, most central banks agree that we need a little bit of inflation, but we should not be targeting deflation. Okay. So so did you guys manage to copy what I wrote? Oops. But anyways, the class is recorded, so you could come back on that. So I'm going to clear that up. And now I want to talk about the cost of inflation, okay? And then probably we're going to make a quick break. So the cost of inflation. So I said inflation is usually not a good thing, first because it's not positively correlated with growth, but in addition to that, there are some costs. So let's look at them. So inflation is bad because it generates costs, which we call the cost of inflation. First one is called menu cost. What are those? Menu cost corresponds to the cost of price adjustment for firms deciding on new prices. That is, for instance, if you're running a business, if prices keep rising, you need to print new price lists and catalogs, and that's expensive, right? You need to send those new prices and catalogs to dealers and customers. You need to advertise those new prices. So you see, when there is inflation, there's a whole range of things that you need to do and spend money on to keep pace with rising prices. For instance, if you're a restaurant, you're gonna have to print new menus. Okay? I mean, if prices increase and if prices double every year, you're gonna have to print new menus. When people walk into your restaurant, you want to make sure that they have the right prices, right? And by the way, that's why we call them menu cost. Menu. So that menu cost. So the first cost of inflation is the fact that when prices rise, there's a whole range of adjustments for firms that needs to be done in terms of catalogs, price lists, menus, and so on. So that's a cost. Second cost, it's called shoe leather cost. So I should put some quotation mark here because it's a metaphor. What is a metaphor? In the sense that when there is inflation, people don't want to hold on cash, right? Because cash is losing value rapidly. When there is high inflation, typically people don't want to hold too much cash. They want to go to the bank and make a deposit on some sort of saving account that would protect their money from high inflation. Okay, so we call that shoe leather cost because in the old days, when there was no all this electronic banking going on, and when people were using more cash than they are nowadays, every time they were receiving cash and inflation was high, they were rushing to the bank to make a deposit. They didn't want to hold on to their cash. They wanted to make a deposit in order to be protected through some sort of positive interest rate on the savings account, right? So because they were making a lot of trips back and forth between their various different places and the bank, their shoes were wearing, right? So and because shoes were made of leather, and in particular the bottom of the shoes were made of leather, it was wearing rapidly. So that's why we call them shoe leather cost, right? So it's a metaphor saying that actually this time and energy running around fighting inflation causes your shoes to wear out faster, right? It's a metaphor. Basically, the cost of inflation is about saying inflation is about realizing that you are spending a whole lot of time, energy, and resources trying to fight the effect of high inflation rather than spending this time, energy, and resources on productive activities, right? Because all those activities that you're engaging into, they are not productive, right? Printing new menus, going to the bank, all that is sort of you're losing time in a sense, right? So this is a very important sentence that I've just written here. So I recommend that you remember it. The cost of inflation is about realizing that you are spending a whole lot of time, energy, and resources trying to fight the effect of high inflation rather than spending this time, energy, and resources on productive activity. You see, that's what we mean by cost of inflation. Okay, but there's some more. Misallocation of resources. Yes, because market economies and agents, they rely on relative prices to make economic decisions, right? So when prices change all the time because of high inflation, I mean, remember, what in Venezuela, we're talking about 2,000% inflation and rate per year, right? That means prices double every month, pretty much, right? So how can you make good, sound economic decision in a high inflation environment? It is impossible. The idea here is the following. It is impossible to make good, solid, sound economic decisions when prices move all the time. Because you get confused about real relative prices and therefore about real values, right? So you may make, you probably will make you will make poor economic decisions. Right? That's another cost. No doubt about that. You're going to be making poor economic decisions. Right? So let's proceed. Wealth redistribution. That's another cost. Yes. When you have inflation, that means the real value of debts is falling. I'm going to take an example here. Assume, so inflation. Assume you buy a car. Assume you borrow $1,000 to buy a motorcycle. You owe $1,000. Assume inflation is 100% per year. So this year, motorcycle costs how much? Checking that you're listening. If there is 100% inflation, you borrow 1,000 to buy a motorcycle because that's the price of the motorcycle. If there is 100% inflation, what's going to be the exactly 2,000? Okay, so the next year the motorcycle costs $2,000. But your debt loan is still 1,000, right? So the real, I'm going to put that in capital letter, the real value of your debt has by 2. So inflation benefits borrowers and harms lenders. Yes, it does. It benefits lenders. So you see, you borrowed 1,000 US dollar to buy a motorcycle because that was the price of the motorcycle. You buy the motorcycle and you told the lender, I'm going to pay back next year. Okay, fine. And then suddenly there's a big boot of inflation. All prices are multiplied by 2. There's 100% inflation. So when you pay back your lender, the people that lent you the money, you're going to be paying back 1,000 US dollar because that's what you borrowed from him, right? But with this 1,000 US dollar, he will be able only to buy half a motorcycle, right? So he's, excuse my French, screwed in the operation, right? He's getting his $1,000 back, but he can now buy only half a motorcycle, right? So that's why we say inflation benefits borrowers and harms lenders. And for deflation, it works the other way around, right? Deflation is good for lenders and bad for borrowers, all right? Uh, I think I'm going to stop here. We're going to make a quick break, 5 minutes break. And when we come back, I'm going to talk about this last cost of inflation called the inflation tax. And then I'm going to ask if you have any question. Okay. So 5 minutes break so you guys can grab a cup of coffee or tea or whatever. Okay. Okay, welcome back, everyone. Welcome back. Okay, so before taking any question, let me see where we stand in the course so that I can anticipate. Um, if you excuse me, just 10 seconds, please. Sorry about that. Okay, can you give me more detail on cost number two? Yes. Let's go back to cost number three, misallocation of resources. Um, so the idea is to make decisions every day in your life. You're looking at prices, right? Should I buy this cup of coffee? I like it very much, but maybe it's too expensive, so no, I'm not going to buy it. Should I take up this job? It looks interesting. It's well paid. Yeah, but I'm gonna have to. I'm gonna be coming back late. I'm gonna be spending less time with my husband and my kids. But still, the money is very good. So maybe I'm gonna take up the job, right? So you see, every day in your life, you're making decisions that are based on prices. The the point of this cost number three on misallocation of resources is saying when inflation is very high, when prices move all the time, then people get confused about the real value of things, the real value of labor, the real value of goods and services. So they make poor and bad economic decisions because they are not able to process all this changing information about prices, right? So because they make poor economic decision, the allocation of resources that is based on those economic decisions is bad as well, precisely because they made poor economic decisions. You see, another way to look at it is to say, assume prices are very stable, 0% inflation. There has been no inflation in Vietnam for the last 10 years. I know it's not the case, but assume that was the case. But that means you would have a very, very good idea of relative prices. So you would have a very, very good idea of what's the value, what of that particular good or apartment or job with regards to the rest, right? So you would be able to make good economic decision because you understand their relative value. You see, that's what I'm saying. So can you, okay, so but to be more expensive, why we do not buy today? It means the increase of item A price is difference. Item B. Mm, will be more expensive. Why do not buy today? I see. So you're saying when there is inflation, people will be. So I understand what you're saying. So you're sort of saying it's the opposite to deflation, right? Um, if prices go up, people should buy right now. Okay, that's something you observe, for instance, in the housing market. When people see that prices are rising, sometimes they rush to buy an apartment or a house because they're afraid it might become more expensive in the future and they would not be able to afford it. So you're right. There's some of that phenomenon going on, but that would be mostly on the housing market, right? And so one thing to keep in mind is that also there is inflation, revenues are increasing as well. So, um, but we'll come back on that at some point. So I hope I answered your question, or at least I hope I answered the question first, understood the question. I'm not sure, uh, but so perhaps I'm going to cover cost five, and I'm going to give you the floor for more. Yes, sir. Good. Thank you. Um, I'm gonna finish with cost five, and then I'm gonna give you the floor if you have more questions on those costs. Okay. So the last cost of inflation is called the inflation tax. What is it about? But it's the idea that inflation further reduces the already negative rate of return on cash holdings. Therefore, agents hold less cash, which leads to less consumption. Let me briefly explain what that means. When there is inflation, high inflation, people do not want to hold much cash because it is decreasing in value. Therefore, by holding less cash in their wallet or Casa account, they have less money to spend right away on, for instance, impulsive purchases, right? Because of that, there is less spending in the economy. So in that case, inflation works like a tax on cash holdings, reducing the spending for GDP holding. Okay, so that's the idea. It works. Compare it as a tax. Inflation is a tax because if there is high inflation, people don't want to have too much cash on their wallet or on their spending account. They move it to a savings account. Therefore, they have less cash to be spent on the day-to-day activities. So that will reduce mechanically the amount of spending. Sometimes we have money in your wallet, so we spend money because we do have money. If you don't have money in your wallet because you have it on your savings account, you will spend less. That's pretty much the idea. Okay, so so that's a summary of. Oh, sorry. That's a summary of what I wrote a couple of slides before. Inflation is costly because agents spend time, energy, and resources trying to avoid its effect, and this time, energy, and resources could be spent on productive activities. Okay. So inflation is a waste of time in a sense. It's a waste of time, it's a waste of energy, and it's a waste of resources. Therefore, it is costly. Okay, that's the way you should look at it. Okay. So I'm happy to take questions. So summary. Let's make a quick summary. Why do we need monetary policy that is controlling the supply? Because too much money generates inflation. Yeah, graph one. That does not boost real GDP growth. And you see graph two. But there should be a one here. Can I access it? Yes, I can. Graph one, graph two. In addition, inflation generates several different costs that all lead to time, energy, and resources being spent on trying to avoid the effects of inflation, right? menu costs and so on. I think it's a good summary. You can remember that one as well. Okay, so do you guys have any question on that before uh, we look at how monetary policy works exactly? Happy to take question or perhaps clarify a couple of points. Okay, uh, it looks like there's no question, so I will infer that you guys understand all that. Very good. So let's move on. Okay, so monetary policy implementation. So now we're going to look at how the central bank actually implements monetary policy, what sort of tools it is using, and what and how it is using these tools. Okay, so remember, so this is some sort of a summer reminder. The creation of money or deposits by private banks is constrained by uh, the reserve ratio. We know that. Right? It's 3% in Vietnam. It's constrained also by the fact that base money is needed for interbank payments and base money is needed for cash withdrawal. So we have three reasons why base money is needed. And importantly, base money is costly. It's not free. We know it has a direct cost and in addition to that, an opportunity cost. Therefore, central banks can influence private money creation in two ways. They can change the cost of base money, or they can change the reserve ratio requirements, right? There are two options actually. One is acting on the price of base money. So I'm going to put that here. Acting on the price of base money is acting on the volume of base money. Acting on the required volume of base money. See, there are two tools at hand, two in general terms for the central banks. It can play with the cost of base money, that's the interest rate, the policy rate, or it can play with the amount of base money that it is asking banks to hold in reserves, right? So you can ask on the you can act on the price, E, or you can act on the quantity, Q. Okay. And within the first option, there are two ways which we already discussed rapidly. Either you can ask, well, no, we haven't discussed that yet. It's about changing the interest rate. And yes, we did discuss that a bit. That's the discount rate, the second option I'm highlighting here. It's about changing the interest, increasing or decreasing the interest rate when you borrow money directly. So in all this, when you borrow the money directly from the central bank, it's called the discount rate, right? That's when you're asking the central bank directly, right? I'm going to put a C and a B here. But the other option, rather than changing the discount rate, is trying, and that's important and it's new, trying to influence the interbank money market rate. Okay, that is, you have two ways as a commercial bank. There are two ways through which you can access base money. You can access it by asking the central bank directly. It's called the discount rate, and the central bank can increase or decrease this rate. That would be monetary policy also. Or you can, as a central bank, um, intervene on the market for base money, right? So you would step in into the interbank market and increase or decrease the money supply in order to increase or decrease the price of money. And this is called open market operations, right? This is an important piece of vocabulary that you need to remember. Okay? When a central bank steps into the interbank market in order to increase or decrease the price of money by increasing or decreasing the amount of base money in this market, then this is called open market operations. Okay. I have a question. Are interest rate, discount rate, and policy rate the same? Yes and no. Haha. Why? Yes, because they cannot be very different, right? Because if it's cheaper to borrow from the central bank directly, then that's where commercial banks will go and borrow the money, obviously, right? Uh, so typically, the two rates tend to be very, very close. There's some marginal difference, but they tend to be close. And I'm saying no because they're not exactly the same in the sense that the interbank market rate, money market rate, is a market price in a sense that it is supposedly determined by supply and demand. Obviously, the central bank has a huge impact there. So it's not really a market rate, but it is at least theoretically it is a market rate where you have commercial banks that have excess base money that will lend base money, and commercial banks that are in need of base money that will borrow base money. So there's going to be a supply and a demand, and there's going to be a price. So it's the interbank money market rate is supposed to be a market price, whereas the discount rate is not a market price. It's just an administrative price decided by the central bank. Okay. And if you look at the US situation, for instance, remember what I said yesterday, most banks would get the base money they need through the interbank market. And when they cannot raise money on the interbank market, they will go and knock on the Federal Reserve Bank's door through the discount window, the discount rate. And I told you it's typically not a very good sign when, as a bank, you were not able to raise base money on the money market, right? So, but I'm gonna use it typically in the media, in the newspapers, on the internet, they tend to use the policy rate, right? And when they say policy rate, they mean the interest rate, the discount rate. That's what they mean. Okay, they mean the interest rate under the control of the central bank. Okay, that's what it. That's one way of saying it. So all these interest rates are under the control of the central bank. Okay, it's important to have this in mind. Okay, so did I answer your question? Would have been funny to answer yes or no. Yes and no. Okay, but I'm glad you didn't do that. Thank you. Um, okay, so let me say it again. Private banks, they have, no, sorry, central banks, they have two ways to influence the cost, to influence that process of money creation. Uh, they can play with the price of base money. They're going to put a big P here for price, or they can play with the quantity base money needed through the reserve requirement ratio. And here I can already make a comment. In China, for instance, I'm not too sure about Vietnam, but in China, they tend to favor number two, right? I'm going to put the right color. China is red. So in China, their favorite monetary policy tool is playing with a reserve ratio requirement. Whereas in the West, and I'm going to use blue, the US and Europe, it's mostly playing with the cost of base money. Okay? So that's an interesting difference between those two regions in the world. Okay. Okay, so let's have a look in detail on what are open market operations. So again, general view is the following. Open market operations are conducted by the central bank in order to decrease or increase the interest rates on the interbank market. But how does it do it uh, in reality? Uh, Open market operations, which we usually call OMO, consist in the central bank increasing or decreasing the quantity of base money on the market for base money. And if the central bank increases the amount of base money by buying bonds and securities to mm, banks with base money, this will decrease the cost of base money because if you increase the volume of, of something on the market, its price will decrease, right? But if the central bank wants to decrease the quantity of base money on the market, it's going to do it by selling bonds and securities to private banks in exchange for base money. Okay? So I'm going to do a bit of a diagram here. Let me see. I'm going to shift back to my blank. I'm going to draw a supply and demand diagram. Okay? I'm going to put an axis here. And here I'm going to have quantities. So I'm going to have the price of the interest rate, price of base money is we're going to have a supply. I'm going to assume that um, it's not an assumption, it's upward sloping, right? So that's the supply base money. Before I go further, um, so I'm going to draw a demand as well. What I'm going to draw it right now. So to make sure that it's we have the full diagram, and I'm going to use a different color, perhaps green. So first question I'm asking you, where does the supply of this money come from? So I'm using a supply and demand diagram, trying to represent the interbank market. Yeah, that's pretty much what I'm doing here. You can say it's the interbank market. My question to you is the following. Where does the supply of base money come from on the interbank market? Not an easy question, but not too difficult. I'd like you to think. Remember, what is this market for? It's the market for base money. There's probably a supply, there's probably a demand. Where does the supply come from? I'm going to give you a hint. There are actually two sources, but you can give me at least one of them. Where does the supply of base money come from? Take a risk. One is typing. Good. From the central bank. That's one answer, and that's correct. One of the supplier of base money on this market is actually the central bank. You're very right. Cash and deposit at the central bank. Yes and no. This Let's talk about the suppliers. Who are the suppliers? So perhaps I should rephrase my question. Who are the suppliers of base money on the interbank market? You said central bank, good, but you know cash and deposit is not a supplier. It's an item. It's money. So central bank, commercial bank get base money to make loan income. Yes, but that's the demand. Sorry, bank, government, no. Um, unless you think the central bank is the government, but it's typically different. We're going to talk about that. Central bank is part of the government, but it's typically considered a special institution. But if you're talking about the treasury, no. Or maybe in Vietnam, but I don't think so. But definitely not in Europe. The treasury does not do anything on the interbank market. So we have one of the two suppliers. We are missing one. Who are or who is the other supplier of base money on the interbank market? We say the central bank, and I say that's correct. But there are some other important suppliers. Who do you think they are? Currency and deposit by private banks. Again, this is not a supplier. This is you're talking about some type of money. I want a person or a legal entity or something. Someone said the central bank, and I said yes, that's a supplier. From private entity, yes. Private. What sort of private entities exactly? Something we keep talking about, but no. FDI is foreign direct investment. Again, it's a sort of it's an aggregate. It's an economic aggregate. It's not demand deposit. No. Okay, I'm going to provide the answer because maybe you're not following me here. The other supplier, the other suppliers are the commercial banks is excess money. Right? Yes, and listen carefully to what I'm going to say now. Remember the very first exercise we did. We had Bank A and Bank B. I think Bank B was paying Bank A eventually, right, for 10 grand. Well, that means that every day on the interbank market, there are some banks that are making payments, and therefore they are in need for base money. But there are banks that are receiving base money, and perhaps they are receiving more base money that they need for themselves, right? To satisfy the reserve ratio, for instance, or to satisfy the cash withdrawals, right? So if they have excess base money, what do you think they're going to do with it? They're not going to keep it, right? If you are a bank and you have too much base money on your asset side and you don't need it, you're going to lend it on the interbank market precisely because if you lend it, you're going to earn an interest on it, right? So it's very important to realize this, right? I'm going to move to share notes. I think it's going to be easier to type what I want to type. So I'm going to draw a line here. I'm going to say the two main suppliers of base money on the interbank market are one, central bank, two, commercial bank with excess base money with the needs. Right? Some banks they they have just too much base money. Perhaps they've received a lot of payments, right? Perhaps they were paid from bank. Perhaps bank A received a big payment from bank B, from bank C, from bank D, and they're not making that many payments. So they perhaps they had 5% base money with regards to the amount of deposit. So that 5% is way higher than 3%. So they can lend the excess um, base money on the money market. Okay. So I'm gonna write that here. For the supply, suppliers are central bank, central bank with too much. Okay, does that make sense to you? Thank you. It does, right? If you have too much of something you don't want, but you're just gonna lend it. You're gonna lend it also because you expect to get a return, right? Remember, there's gonna be an equilibrium interest rate here, right? So now that you understand what I mean, I'm gonna move back to share notes, and I'm gonna ask you. I'm gonna tell you the main demander for base money. Oh, I'm gonna phrase it differently. Demand for base money comes from only one type of agent, and that would be, so think a little bit before answering and moving back to public chat. Who do you think is or are the demanders for base money on this market, taking into account what we've just said with regards to the suppliers? Who do you think is going to demand base money on this market? Exactly. That's exactly this. The commercial bank that need base money. So if you go back to our exercise one, that would be Bank B. You see, Bank B was in need for base money. So you're very right. Thank you. I'm happy. I'm glad you're following. That's very good. The demand. So I'm going to write that here. Demanders are exactly central bank that has not enough required reserve. That's another way of putting it. I'm going to say commercial bank with need for base money. Okay. Okay. So you see there's a difference, right, between the suppliers and between supply and demand. The supply is coming from two sources: the central bank and the commercial bank. Well, actually, we can add the central bank as well, because if the central bank wants to withdraw, yes. So I'm gonna erase this, and I'm gonna say I'm gonna write that right here. Demanders, central bank. I'm gonna explain to you why. Central bank and commercial bank with need. We don't really care about the need, right? We do care, but what I'm saying is that there are various different reasons. It could be, as you very rightfully said, because it doesn't have enough required reserve, but it could be because of cash withdrawals that are more important than usual. For instance, around the Christmas period. I think you guys are celebrating Christmas as well. It's nice, uh, but you have your own domestic festivities, right? But I know in Europe and in US as well, around Christmas, there's a very big peak increase in the demand for cash, right? So commercial banks will demand base money from the central bank. But the central bank will demand money as well because open market operation is about increasing or decreasing the amount of money supply. So when the central on this market, so when the central bank increases the money supply, it's going to be part of the supply curve, and when it decreases the money supply, that it wants to remove some money supply from that market, then it's going to be a demand. Okay, so is that clear for everyone? Moving back to share notes. Yeah. So I'm going to remove only from one type of agent. I'm going to remove from two types of agents: central bank and commercial bank with need. All right. Back to the public chat. Mm, Clear. Thank you. Yep. Very good. Okay. So last point I want to make on this graph is the following. This is the equilibrium interest rate here, right there. Okay. So that's the price for base money. So assume the central bank wants to increase the money supply. The supply curve is going to shift to the right. I'm going to draw a new supply curve. I'm assuming the central bank increases the money supply on this market. As you can see, if we do that, the equilibrium interest rate on this market has fallen. Okay, that's open market operation. Okay. All right. So I'm going to shift back to the main presentation. And with that again, open market operation consists in the central bank increasing or decreasing the quantity of base money on the market for money. How does it do that? It's going to increase the base money by buying bonds. Yes, that's important. We haven't talked about that yet. How does it do that? How does the central bank increase the money supply on the interbank market? It does by buying bonds, by buying securities from commercial banks. You see, so on this interbank market, I'm going to add a comment here. On the interbank market, banks, CB, commercial banks, and the central bank trade base money for securities, typically bonds, right? So if the central bank wants to increase the supply of base money, he is going to buy bonds from commercial banks, right? In exchange for base money. That's this first guy here, right there. And if it wants to decrease the amount of base money, it's going to do the opposite. It is going to buy base money with government with securities. Therefore, that means it's going to sell securities on this market. Okay, so don't. We're going to come back on this, but I wanted to highlight it right there. Okay, next slide. In the US, the corresponding interest rate is called the federal funds rate. Yes, on the interbank market. So I told you if you borrow directly from the central bank in the US, it's called the discount rate or the discount window. But the name of the interest rate on the interbank market is called the federal funds rate. And how is it decided? Well, there's actually the Federal Reserve Bank Open Market Committee that decides on the federal funds target rate, right? So who is this open market committee in the US? But you have the governor of every single regional Fed. You know that in US they have a Federal Reserve System, which means you have regional Fed with regional central banks, one for New York, one in Atlanta, one in San Francisco. You will have one in Minneapolis, one in St. Louis. You have 12 of them like that. So there's a governor for each. They meet around a table. There's some other people there, like the chairman of the Fed, and they decide, should we increase or decrease this target rate, right? This federal funds rate on the interbank market. That's how they make monetary policy decisions. Actual open market operation make the federal funds effective rate follow the federal funds target rate, right? In the Eurozone, this rate is called Euribor. Reminder, why do interest rates go down when the central bank purchases bonds? So here it's, if you go back to the previous graph, as you can see, I had an increase in the money supply here. I told you an increase in the money supply means the central bank is going to buy bonds from commercial banks in exchange for base money, right? So that means the central bank is going to buy bonds. And the question I'm asking now is, why is it that when the central bank buys bonds, price of the interest rate goes down? Let me give you an example here. Example. So assume issues 1,000 on is interest rate at 10%. Means the coupon is equal to what? Annual, with annual interest rate. Means the coupon is equal to, who can answer that? So the coupon is actually the income from that bond, from holding that bond. I saw some of you that started typing. So and then you stop. I'm sure you have the answer. That means the coupon is equal to, we have a 1,000 bond. It's a 10% interest rate. What is the coupon equal to? I'm gonna make a poll. How about I make a poll? Oh, no, I'm not gonna make a poll. It's equal to 100. You see this? That is 10% divided by 1,000. Okay. The coupon corresponds to the income associated with holding that bond. So you purchased a 1,000 bond. It's paying 10% interest rate annually. That means at the end of the year, the government will have to pay an interest on $100 on that bond that you bought from the government. Okay, is that clear for everyone? So coupon is a French word actually that's being used in English now and everywhere around the world, I suppose, which is the technical financial term that we use to describe the payment, the interest payment associated with holding a bond. Okay, is that clear for everyone? Yes, I'm gonna come to this. Yes, yes. I'm not done with my example, by the way. So assume now that the central bank conducts some OMO and market operations in order to increase the money supply by buying bonds on the interbank market. And assume that this purchase led to the price of the bond rising to, I'm going to make things very simple. I know it's exaggerated, but it's just to make a point here, to 2000 USD. Now my question is, what is the new rate of return or interest rate, if you want, on that? I'm going to make a poll here. Okay, I'm going to say A equal 20%, B equal still 10%, and C equal 5%. That's my poll. Let's make a poll. Polling results, ABC. Let's go, guys. It's interesting. We have a uniform distribution, nearly uniform. All right, so I have 12 answer. I think I'm going to stop here. A bit more now. 12, and actually, C. The correct answer is C. So very good. Let me explain to you why. What's this poll here doing here? There's nothing to do. Okay, the new rate of return is equal to the unchanged coupon. Yeah, it's unchanged because when you bought that bond, you bought the right to earn $100 at the end of the year, right? So that's your revenue. If you keep holding that bond every year, at the end of the year, you're gonna get $100. So the new rate of return of this bond is equal to the unchanged coupon, that is $100 divided by the new price of that bond. And that's 2000 now. So now you see, if you want to put your hand on that bond and get a 100 coupon every year, it used to be the case that you had to pay $1,000. But now, because of this open market operation by the central bank, through which the central bank bought a massive amount of bonds, so massive that the price of bond increased a lot. Then the price of the bond has increased to 2000. Therefore, the new rate of return is equal to $100 divided by $2,000. And that's exactly 5%, right? So, yes, the correct answer was 5%. I'm actually here talking about the real rate of return, the real interest rate on that bond. Okay, so I'm going to move back to the public chat in case there is a question. Do you have a question on this here? What I've just done? I'm just very generally describing the relationship between the price of bond and the average interest rate here. And there is such a relationship because the more expensive the bonds, typically the lower the rate of return. And that's exactly what we have at the moment. Bonds are very expensive. Government bonds around the world are very expensive, and therefore interest rates are very low. Okay? So is that clear for you? Good. We're going to need that. I'm not saying it's essential for the class, but we're going to need it, right? So I want to make sure it's clear for everyone here. Okay. So now we're going to do a quick exercise to, not a quick, but an exercise to finish, right? So so take a central bank and a representative commercial bank with the following simplified balance sheet. So compared to your slide, I've added this. Okay, um, so you have you have a commercial bank here, right there. Oops, what is this? You have the commercial bank here, and you have the central bank here. Okay, the commercial bank um, has some reserves. We've seen that, some loans, and I've added a new account here. Very importantly, it's called securities. And now we're close to a very realistic balance sheet for our banks. I told you at the beginning, I think on Monday, I told you typically on the asset side you have reserves, loans, and securities. And so far we've been we've been working only with reserves and loans. But a large share of the assets of a commercial bank is actually securities, right? And on the other side we have deposits. So that's nothing really new here. 40K for reserves, 60K for loans, and 100K for securities. As a result, you have 200K for deposits. Okay. Now let's talk a little bit about the central bank, because the central bank is slightly different, right? A central bank balance sheet is simpler actually. There are only two items. On the right hand side, you have the base money. Oh, look, it's very similar to a commercial banks, right? A commercial banks issues deposits, creates deposits, and a central bank creates base money, right? So uh, it's a liability for both of them. For a commercial bank, a deposit is a liability in the following sense. If you walk to a bank and you say, I want my money back, they have to give it to you. So it's a liability. Okay, but it's the same for a commercial bank, right? For a central bank, sorry. When a central bank, the bank of the money issued by the central bank, which is the base money, is also the central bank, is also a liability, but for the central bank. Okay, it's a recognition of a debt in a sense. Okay. So that's for the asset side, for the liability side. Sorry, on the asset side of a commercial bank, of a central bank is the securities. Okay, that the central bank has bought uh, with that base money. So here I want to move back briefly um, to a blank my blank presentation, and I'm gonna use to find which one would be optimal to use. Yes, that's good. So here I'm going to describe, just to make sure you understand before you do the exercise. So I think oops, You're going to do the exercise as homework for tomorrow because we won't have the time tonight. Example, case study. Central bank. Central bank is born. In that way, the central bank is born and issues print its own money to buy securities from banks, from commercial banks. How is this going to translate on? So assume there's a new country being created. How about glorious Vietnam? A new Vietnam. I don't know. You guys would invade Thailand, for instance. I'm just kidding, right? Hope there's nobody from Thailand in there. But assume you invade Thailand, you say it's not going to be Thailand anymore. It's going to be Vietnam, Great Vietnam #2. So you create a central bank there, and the central bank will have to buy securities on its first operation. How is it going to work? It's going to work like this. In the same way, so assume it's going to buy 1 million. You're going to have plus 1 million securities here. In the same way, a commercial bank can purchase a loan, can create a loan. A central bank can purchase securities by creating its own money. So we're going to have base money here for the same amount. You see? The reason I'm doing this is because I want you to understand where this balance sheet is coming from. That's the way it works, guys, okay? When a central bank decides to buy securities, it's going to create its own money. Exactly the same as when a commercial bank decides to make a loan, it's going to create its own money, but rather than having um, loan, a loan, remember for a commercial bank, we had loan here, right? Here we don't have loan, we have securities, right? The central bank will use that money to buy securities. But in a sense, a loan is a security as well, right? It's an asset that pays some dividends or some interest, just like securities do. Okay. So in terms of total, obviously, we're going to have both the total that would have increased by the same amount. So the balance sheet is still in equilibrium, right? Okay, so it's important to understand in order to do the exercise that in the same way, commercial bank, I'm going to write that stuff here. In the same way, commercial banks can create their own money. By that I mean deposits. Deposits to buy bonds. In quotation marks, they're not really buying it, but in a sense they are because it's an asset that's paying interest. The central bank, so in the same way commercial banks can create their own money to buy loans, the central bank can create its own money to buy securities. It's pretty amazing, right? The commercial banks, they cannot create their own money to buy stuff, right? That they cannot do that, to buy securities for themselves. Okay, we're going to come back on this. Okay, so let's move back to the exercise so that I read it for you, explain it to you. So you see, that's how we ended up here. Okay, we assume that this central bank has some securities right there, and those securities, right, securities, and those securities have been bought by base money. Okay. All right. So exercise 4. Take a central bank and a representative commercial bank with the following simplified balance sheet. Assume that the central bank conducts some open market operations, expanding the money supply by 15,000 US dollar, all of which benefiting our representative commercial bank. So you see, we have some open market operations going on here. Okay. The central bank expands the money supply, which means it's probably going to mean it's going to buy bonds, right? So question number 1, represent the central bank and the representative commercial bank balance sheets after the open market operation. Okay, that's question number 1. So you start with this. You say, okay, I'm the central bank. I'm going to buy some securities for $15,000 from this commercial bank. How are the commercial bank's balance sheet and the central bank's balance sheet being impacted by these open market operations? Okay, that's the first question. Question number 2, what are the implications for the interest rate? And therefore, you should go back to what we did here. Okay. The money multiplier, and by money multiplier here, I mean, I'm going to write that here. A simplified version of the money multiplier equal to M1 divided by M0. Okay. Why is it a money multiplier? Because M0 is base money and M1 is only some base money in there, but there's also all the deposit at private commercial banks. So, and we know there's a relationship between M1 and M0 through the money multiplier. We've seen that yesterday. And finally, what are the implications for the commercial bank's profitability of this open market operation? Okay. Question number 3, what differences do you see between the way commercial banks create money and the way central banks create money? So that's important also, that you're going to see, I briefly talked about it already, but there are some differences in the way commercial banks create money and the way central bank create money. Okay, so this is the exercise I would like you to do. So because it's nearly time now, we're not going to do it today. What I would like you to do, if you don't mind, is try to think about this exercise, perhaps on your own. Perhaps on your own, because I will not be able to do those breakout rooms, because obviously you will the class will be over for today. So think about it on your own, and tomorrow when we reconvene, I'm going to provide you with the answers. Okay. But before we do that, I would like to see whether you have any questions on what we've done, any question on what we have done, or on the exercise itself. Okay. So, by the way, I'm going to come back and extensively on this central bank balance sheet, how it works, how it operates. Don't worry. So I just wanted to give you some sort of introduction so that you can do the exercise. But we're going to do a lot of exercise on this as well. So, but still, I'm very happy to take questions. Sure. Can so that you mean CB? Can a central bank refuse to buy or sell bond? All right. So it's not whether it will refuse or not. Actually, it's the central bank will step in into the interbank market, and so in my example, it's buy some bonds. Okay. There's a price for everything. You see what I mean? So if one bank says no, I don't want to sell this bond, like the central bank can come back and say, how about a higher price? Do you see? there's always going to be someone that's ready to buy. It depends on the price you're offering. And if you offer a very high price, yes, you can refuse, but it's not in your own interest. So the thing is that the central bank will add some base money or remove some base money from the interbank market depending on its own objective in terms of interest rate, right? And because it's a very large market, there are a lot of banks, a lot of suppliers, a lot of demanders. It is possible to implement the interest rate you want. Okay. So does that make sense to you, sir? Before I answer the other question, thank you very much. Second question: the article you sent by Werner said that money in commercial bank is created after the grant of the loan. Yes, but in your previous example, you said that the central bank, just like commercial bank, creates money to buy loan. No, 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 no. Sorry, maybe I wasn't clear enough. I was just making a comparison. Let's go back to this. As you can see, I've removed loan here. Uh, the base money that the central bank creates, it uses it to buy securities, not to make loans. Okay, central banks can make loans, and they do make loans. Okay, um, but it's not their main job. Okay, the main job of the central bank is conducting open market operation, buying and selling securities in exchange for base money in order to increase or decrease the cost of base money. Okay, they make a few loans from time to time to the treasury and so on, but that's not their main job. It is central. It is the main job of commercial banks to make loans. So to come back on your comment, no, I did not say that. The article you sent us said that money in commercial bank is created after the grant of loan. That's right. But in your previous example, you said the central bank, just like commercial bank, creates money to buy loan. No, I didn't say that. I was trying to make a comparison. That's why I use a black color instead of red to say that commercial bank buy loans, but the central bank buys securities. Okay, is that clear now? Okay. Other question: how can the two actions, change the cost of base money, change the quantity of base money, influence private money creation? Well, that's a very important question. We're gonna talk a lot about that tomorrow, but let me give you the answer right now so that you understand why we're doing all that. Every time a commercial bank makes a loan, it expands its balance sheet and therefore it increases deposits. But I think I've wrote that at some point. The larger your deposits, let me try to find this. It's not here. I'm gonna move back a little bit because I've answered that already. Oh, no, it's in, I remember now. It's in the shared notes. So let's go back to the shared notes. Um, you see, I've highlighted it right there. Can I change the color? I'm gonna like this. Can you see it's highlighted here? The larger the amount of deposits, the greater the need for base money because of 1, 2, 3. Okay? Because base money is costly, the central bank can raise or decrease that cost, raise and decrease the required amount of reserves, right? So to answer your question, how can those two actions, change the cost and change the quantity, influence private money creation? Because if it's that's very important what I'm going to say right now. If it's more expensive for commercial banks to access base money, or because they need more base money, then they're going to pass on this cost. I'm going to write this here. If the cost of base money has increased, commercial banks will pass on this cost to customers. And then customers will reduce their loan demand. Okay? Really important. It's really important. Okay? Their loan demand. Oops. So that's the whole point of monetary policy. It's about increase. Assume we look only at interest rate. You raised interest rate. That makes base money more expensive for commercial banks. Therefore, commercial banks will pass on this cost to their customers because if they don't, they're going to start losing money at some point. Okay? We're going to come back on this tomorrow. And conversely, if the cost of base money decreases, then that means commercial banks are making more profit because they're charging an interest rate on the loan, but they're paying less to access base money. So they're making more profit, but typically one bank will decrease its own interest rate in order to grab the market. So we're going to talk about that tomorrow, but it's a good question. You understand? Good. Next question. Can you explain the balance sheet of central bank when they issue government bonds? Yes, I can, because central banks do not issue government bonds. Here we have a vocabulary problem. I'm going to go to the share notes. I'm going to draw a line here. A government bond is issued by the Treasury, which is different. A central bank bond is called central bank bond, so it's different. Okay, that means because by government we usually mean treasury. You can see that the central bank does not issue government bonds. It can issue its own bonds, though. We're gonna talk about that. Is that clear for you? Can you explain the balance sheet of a central bank when they issue government bonds? So you mean when issuing a central bank bond, perhaps? I can do that. I think I'm going to do that tomorrow. Okay, I'm going to write it down on my pad. I'm going to do that tomorrow as an exercise. Okay. I'm going to ask you to do it as an exercise tomorrow, if you don't mind, young lady. Okay, and next question. So for central bank, money appears after securities. What do you mean by that, after? For central bank, money appears after securities. No, it's not after. For a central bank, securities are on the asset side because they buy securities. And the money that it has issued appears on the liability side in the same way, because it's a liability in the same way as commercial banks, in the same way as deposit at commercial banks are a liability for commercial banks. You see what I'm saying? I'm answering the question from yes. Did I answer your question? I guess it perhaps you could rephrase it or reformulate your question. Hopefully, I've already answered. I was hoping you would give me some feedback on my answer to your question. Ah, yes, you are. I can see you're typing. And I'm going to take the next question. I'm waiting for the messages to show up. Thanks for your answer. You're very welcome. But I haven't answered your question, by the way, so I'm going to do that. I can understand that the central bank buys bonds from commercial bank as the same way as commercial bank lends money to their customers. Yeah, exactly, exactly. They do that to increase their asset. It's amazing, right? Those banks, they can print money to increase their assets. I wish I was a bank. I could issue my own money to buy stuff. Well, you unfortunately, as individual, we cannot. We would need a banking license. That's what makes them bank. Okay, to issue your own money, you need a banking license. Okay. So, but that was an interesting comment. Yes, they can print their own money to increase their assets. Of course, it's very well regulated. Right? The banks cannot do whatever they want. Right? In particular, they cannot print money for themselves. Right? They can print money for their customers. They can lend money to the customers. They cannot lend money to themselves. Okay. All right. I think he means the securities appear on the market first, then government issues the money. Yes, that's right. Yes, that's right. Yes, that's right. But that made me think about this exercise of central bank bonds. So we're going to do that tomorrow as an exercise. Um, all right. So I guess that's it for today. I don't think there is any question. So tomorrow when we reconvene, we're gonna go head on with the exercise. Okay. So I would like to thank you for your attention, for answering my question, for asking question, and I see you tomorrow.